Hey, Mr. Mortgage Man.
Hey, Martel, how you doing?
Good. Quick question.
Yes, sir.
What's the difference between a fixed rate and an adjustable rate mortgage?
The difference between a fixed rate and an adjustable rate mortgage? Man, that's a good question. Because that's something that people need to know so that they'll know what their options are when they're buying a house or actually refinancing a house also. The difference is a fixed rate mortgage is a mortgage that stays the same for the full term of your mortgage. So for example, say you have a 30-year mortgage and your rate is at 3%. Then for that 30 years, your rate will remain at 3%, which means your mortgage payment will remain at that same payment also. The only thing that may fluctuate is not because of the rate, but because of the taxes and the insurance on your home. Now, an adjustable rate mortgage is a mortgage that starts out lower than a fixed rate. So for example, if the fixed rate was at 3%, your ARM rate or adjustable rate mortgage may be at 1.5, 2.5%, 2%, something like that. And it'll be that way for a certain amount of time, meaning let's just say it was at 2%, which gave you a lower payment on your monthly basis. It may be at that rate for 1 year, 2 years, 3 years, 5 years, 7 years, or maybe even 10 years. But after that, the rate will start to increase, or it could increase depending on how the market is at that time. So very good question. Anytime we meet with our clients here, we always do a mortgage consultation to identify what our clients' goals are, and meaning, and one of the most important things that it goes is how long you plan to be in the house, because that would dictate, that will help to dictate what type of mortgage rate you should be in, whether it's fixed or ARM rate. So good question, Martel. I appreciate you asking that question.